Hey everybody, part 4. Alright, so let's get into some journal entries that have those shipping terms in them. Alright, March 1st, blah, 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 women's clothing store purchased $14,000 of merchandise from a supplier on account, terms FOB destination. That means, right, FOB destination, we have to get it all the way to the buyer to its destination. We're making the purchase though, so FOB destination means that the seller is paying for it. They have to get it all the way to the buyer. Which means Alyssa, who is the buyer, doesn't actually have to pay those shipping costs. So we've got merchandise inventory, accounts payable. Alyssa returned $2,500 of the merchandise. Oops, oh, here we go. I forgot I did T accounts. There we go, 14,000, 14,000. We are going to return some of it, accounts payable, merchandise inventory, nothing different than the entries we did earlier. And then the payment on March 9th. The payment on March 9th, that's within the 10-day period. So we are going to be looking at a discount here. All right, the discount's going to be 2% on the $11,500 that we owe, $230 discount. So the cash we're paying is going to be the $11,500 minus $230. So our journal entry is nothing different than what we had been doing before, right? Same as we did with those last series of problems. The point being here is you had to know that we weren't paying for the freight, okay? Not that I even gave you a freight cost, so I don't know how you would, but FOB destination, point being is that it has to get all the way to the buyer, and we are the buyer, so we're not paying for anything. Okay, oops, there we go, forgot that last piece, there we go. $11,270 matches the $11,270 in cash we paid. I'm not going to go through the explanation again, we did that in the earlier video. Alright, so let's try a different way. S&V purchased $1,000 worth of merchandise in account, terms 210 net 30, FOB shipping points. That means that it is all they have to do is get it. Hang on. Oh no, I can't click all the way that far back. It'll take too long. All right. That means that we're purchasing it. We're S&V. We're purchasing it, but the terms are FOB shipping point, which means the buyer is paying because all the seller has to do is get it to the shipping point, and it's the buyer's responsibility to pay for it to get there. All right. The freight costs of $50 were prepaid by the seller and added to the invoice just as, they're charging us for it. We're the purchaser. So the inventory and costs include purchase, freight, taxes, right? Typical inventory costs. So the merchandise inventory we're paying $1,000 and we're paying $50 to get it to us because we are the buyer and we are including those costs as a cost of inventory. So merchandise inventory, accounts payable. Now we're going to pay within the discount period. But realize that $50 that we were paying here is really like the money they paid to like FedEx to ship it to us. So the people we're buying from are offering us $1,000 discount or discount on the $1,000 of merchandise, but they're not offering us a discount on the $50, right? So the discount is only going to apply to that $1,000. So here's our little T counts, 1,050. But the discount part is only going to apply to the actual merchandise we're purchasing, right? Like I said, FedEx, that extra $50 we paid for FedEx, they don't care about our discount. So we will have a $20 discount, which means we're only really paying cash of $1,030. Okay, so the point of this problem, it's the same kind of math, basically, that we've been doing, but I am showing you that the discount is only applied to the inventory, not necessarily to the freight. Okay, and there's the... Okay, so journal entry-wise, though, we stay the same. All right, so now let's get into selling transactions, right? Now we know that, so we've done with purchases, let's talk selling. Now, selling has that two-part entry, if you remember we talked about in the very first or second video. We have two pieces. We sold, and we'll show you that right now. All right, if you need the explanation on that, go back to video 2. Sold $500 of merchandise to a cash customer. Cost of the merchandise sold was $280. So we've recorded the cash and the sales revenue. And the second part, we record the cost of the goods sold and the merchandise inventory, right? So there's always the two pieces, the sales piece, the inventory piece on a sales entry. The net of those two, right, if we were to do an income statement at this moment, we would have sales revenue $500 minus cost of goods sold of $280, and that would give us gross profit of $220. Right? So it's really these two combined that give us our profit piece. We don't actually record the profit as a journal entry. All right, so here's a little example. Sold $1,200 of merchandise to a customer who charged the merchandise to her Visa card. Cost of the merchandise was $9.50. All right, so I know there's this little graphic here. The idea is that how does this even work, right? If you are going and you are using your Visa card and you're paying for something you bought at Macy's, what happens is Visa turns around and gives Macy's the money pretty much immediately within a day. All right, so Macy's gets what you bought. And then the idea is that they usually take a cut. They take 2 to 4%, and they charge Macy's for a percentage of that money for getting it, for the honor of using their Visa card. And then if you don't pay your bill right away, then they get you for the extra percentage, you know, the late fees and the percentages and so on. So that Visa card, that's great to have in your wallet, and it is, but you got to make sure you don't get hit with those 22% charges. Never charge anything you can't pay off in the next month. It's not worth it. Okay, but that's how Visa makes its money on both ends. They make it from you for not paying on time, and they make it from the stores themselves. They charge them a percentage. So, a little piece of information. But from a journal entry standpoint, we treat that sale the same as we would normal, right? Cash, sales revenue, we treat it as cash because we're getting that money within a day from the Visa people. All right, so the journal entry itself is the same. All right, here's another one. Sold $2,000 of merchandise to a credit customer on a store account. Terms of sale, $210 net $30. Cost of merchandise was $1,600, right? We know we made $400 in profit, but we are going to sell it within the discount period. So here's something a little bit different. The discount is 2% on $2,000, right? That's what they're offering. So accounts receivable, we recorded it as full $2,000. That's fine, right? We made the sale, $2,000. We don't know if somebody's going to take advantage of our discount yet. We're making the sale, and we offer those credit terms to our customer, right? We're selling now, not buying. So we have the receivable for $2,000, and we have sales revenue for $2,000, and we have cost of goods sold, and we've got inventory. Nothing here has changed yet from the previous entries. The question is whether or not they will take advantage of the discount. So we're using the gross method. Sorry, there's the gross method way of doing this, and there's the net method. Your book uses the gross method, so that's what we're doing. Net method isn't used too commonly. Okay, so anyway, point is we record the sale at its full amount, and that's why we consider it the gross method. We record it before the discount. All right, so now let's move on to the next one. We received a payment from the credit customer in 3 within the discount period. Okay, so they're paying us the $2,000 they owe us, but they're getting a $40 discount because they're paying us within the period. So here we go. We've got cash of $1,960. Now that makes, too far, the other way. That makes sense because it was $2,000 was the receivable minus the $40 discount we're offering them. That's $1,960. So the cash we're getting is $1,960. But we have to take the whole receivable off the books, so that full $2,000 comes off. Now we're off by $40. That $40 is a sales discount. Okay, that is an offset to sales revenue. So what you'd have, if I went all the way back up, sales revenue of $2,000 minus sales discount to $40, our sales revenue is $1,960. Ooh, look at that, I did it here. $2,000 minus the sales discount, and we would net these two together to show $1,960 as that net sales revenue, that first number on the income statement. All right, assume the payment, let's pretend instead that they did not pay us, okay? So the other way, let's just, they paid us but not within the discount period. If that's the case, then they owed us $2,000 and we got $2,000. No discounts at all. Okay. All right, moving on. There's a lot of examples here. All right, I'm going to scroll through these examples. They are the same ones. I have students do them in the face-to-face class to practice. You guys are online, a lot of you, so I'm not going to pause and make you do that, but nothing here is new than what we just did, okay? All right, so let's do this big example. I know it's a lot. I have a lot of T counts on the bottom here. Very exciting. So let's go through how this works. Tiffany sold $61,000 of sports wear on account, credit terms $210 net $30, right? Cost of goods sold is $32,000. Nothing new. Accounts receivable, sales revenue, but I am going to keep track of them. Accounts receivable and sales revenue. Okay, so there's that. And cost of goods sold and in merchandise inventory. Here's cost of goods sold. Here's merchandise inventory. Okay, so I want to keep track of them for a reason. You'll see as we go along. All right. What I have a gap here is because these two items are assets on the balance sheet. All of these guys are on the income statement. Okay, so Tiffany Sportswear received a $2,000 sales return on damaged goods from the customer. Cost of goods damaged is $1,050. Remember now, we're selling things. This isn't purchases. This is sales. So somebody sends it back to us. We have a new account called Sales Returns and Allowances. Because if you're running a business, wouldn't you want to know how much of your product comes back to you? So it's important to track, right? So somebody sent back $2,000 worth of stuff, and they no longer owe us $2,000 because, right, we had a receivable for all 61, but somebody sent us back 2 of it. So let's track that. We got sales returns allowances $2,000, and we reduce our receivables by $2,000. The other piece is the inventory piece. We're putting the inventory back on the kind of back on the shelves. It's damaged, but anyway, we're increasing the inventory count $1,050 and decreasing cost of goods sold. So it's almost like this is a reversal of that. All right, so 1,050 here and cost of goods sold over here. We kind of do something else with damaged inventory. Not really sure why this problem has that doing anyway. Well, we're just going to go with it. All right. Tiffany Sportswear receives payment from the customer on the amount due less the return and less the discount. Remember, we offer them a 2% discount. So if at this point their receivable balance is $59,000 and we offer them a 2% discount, you kind of have to do that math on the side. $59,000 at 2%. Oh, I did look at that. I did there. Is $1,180. That is the amount of cash we expect to receive from the customer. So cash, $59,000 less the discount, $57,820. And the receivable, we have to take the whole receivable off the books, all $59,000 of it, right? And we have the account sales discounts. And there you go, there's sales discounts. So we had returns and we have sales discounts when we offer that kind of discount. See, there we go. Sales discounts, there's the amount. So these guys, like I was saying, are balance sheet items, right? They're assets. But these guys all together, sales revenue minus sales returns and allowances minus sales discount, that gives you that net sales number for this income statement. And you see how they carry opposite balances. These guys are contra accounts to sales revenue, meaning they carry opposite balances and they go against them. So it's sales revenue minus sales returns and allowances minus sales discounts because they carry opposite balances. And then it would be minus cost of goods sold, right? So, well, there's that. And then it would be minus the cost of goods sold number, gives us gross profit. Okay? I hope that helped you. All right. Moving on to the next one. Pause and restart at the next one.